For the wine critics that are watching, you all know that even the best, most prized wine labels can have good years and they can have bad years. Things like sweetness and tannin all factor into whether a wine is good that year. But if you swap out sweetness and tannin for things like covenants and pledges, our next guest says that helps him find some of the more valuable vintages in bonds. I'm joined by Greg Kosick. He's head of high yield bond group at TD Asset Management. I feel like we should be drinking while we have this segment, but we will not. Before we get into the actual things we're talking about there, there's something that you said is somewhat remarkable in terms of the performance in high yield bonds lately.
Yes, I mean last year was unusual in pretty much in every asset class, but if you look at high yield versus investment grade bonds, the performance was somewhat surprising. Investment grade bonds have done better than high yield, and within high yield, you had outperformance of long duration bonds versus the short duration bonds. Typically, when you have a rally, you have a low quality bonds rallying, triple C's, single B's, doing much better than better quality bonds. Mm-hmm. This time around, it was the other way around.
And why is that?
It was really, the whole rally last year was driven by interest rates coming down.
Yeah.
So it was the Federal Reserve as well as the government bond yields doing much better. So that drove everything, including equities, including high yield. It wasn't really, the market wasn't really making a big bet on the improving credit quality. It was making a big bet on the decline in interest rates. And that pretty much overshadowed everything else. And my point about bifurcation is that it's never happened to such an extent before. Literally in 30 years that we've looked at numbers, we've never had such a rally driven solely by interest rate movement to such an extent. And you know, when you look at government bonds, you don't really see it as much. I mean, there was a big rally there, but what's unusual is that within high yield, the long, like a 10-year bond, did so much better than a 5-year bond. Remarkably better. The numbers are just staggering.
Interesting, and again, driven by the interest rate, because that's,
yes,
that's what impacts the duration.
Exactly.
Let me ask about the wine piece now and the vintages, and you talk a bit about how you think about evaluating a bond, because you know we were talking about this earlier, and there's something that's come about that you know there's certain vintages of bonds that are really outperforming others. So what are you seeing right now?
And vintage is actually the term we use quite often. Maybe not in official publications, but internally we use these terms quite often. So what's happening is the covenants that are part of the bond issuance are changing all the time. So if a company issues the bonds today versus 2 years ago, the structure, the document that comes with that issue is quite a bit different, depending on the market conditions. If there's a lot of demand for these bonds, if the company is doing really well, they will be able to get away with much weaker covenants, or they will demand much better terms from investors. Mm-hmm. And the flip side is if the company is not doing very well, or if the market in general is a little stressed, the investors are able to demand much better terms in terms of being able to control the company's performance a little bit better. The thing that is different, which is kind of obvious, but different from bonds versus equity, when you're buying Apple stock that was issued 10 years ago, 5 years ago, or 2 years ago, is the same stock. Yeah. It's the exact same thing. It's the share of
There might be the number of shares outstanding might be different, but essentially,
it's the same share ownership of the company. When you're buying a bond, issued by Charter Communications or actually even Apple, issued 2 years ago or 10 years ago, these are different bonds, different documents, and some of them are better, some are worse, even though the company's the same.
So is this a case where older, with the things that is like old, appliances, they're better in the old days?
I think, things get better with age sometimes.
Yeah.
And sometimes wine is a great example, and the credit cycle in our world, in the world of bonds, is a very good example where early on in the credit cycle you have much better covenants.
Now, if we could, we got some examples here. I think we got a picture of Seagate bonds and a price change. Can you tell me a bit about this one, but also, I mean, we've only got a couple of minutes, a bit about the covenants at the same time.
That's right.
What types of covenants are changing and are different?
So this example is showing two different maturities. Seagate is a company in a memory business in the US.
Yeah.
It's a BB+, BBB- bond. Their bonds, their 15-year bond has delivered 40% plus return last year, and their 5-year bond has delivered something like 20% or so, half of the return. I mean, both returns are not even equity returns. These are venture capital type returns from a very strong company. A lot of that is driven by interest rate movement last year. And my point here is that if you were buying a year ago these two bonds, one you were buying at 75 cents, the other one you were buying at 95 cents on a dollar.
Yeah.
They're both now trading at something like 110 cents on a dollar. So they converge to the same price, and you realized significantly better performance from that long bond. Now, typically a longer bond in a rally will do better, but not by 20%.
Yeah.
We've never seen anything like this.
So if you could, then what is the difference? I mean, either with this one or in general, is this just like the covenant is different?
This one, it's more the duration. It's
Yeah.
just the term to maturity is so much bigger, and those long bonds did better. The covenant comes in other examples, and typically the best covenant that we look at is restriction on additional debt. So the company will have to, for high yield investors, we want to make sure that when we're already assuming fair amount of risk of a highly leveraged company, we want to make sure that this company is not going to go out and increase that debt, next week. So there's a hard cap as to, is it 5-to-1 or 4-to-1? And that hard cap will change depending on whether the market is strong or if the company issued the bonds in a weak market 3 years ago, that cap was very good for us. Last 3 weeks, the market is very strong, and we're getting really bad covenants in the market. So basically, that is very strong differentiating point for investor.
I wish we had more time, but we don't. But we'll have to leave it. But I'll say that is the entire reason you have active management and high yield right there in that one example.
Great.
Greg, it's a real pleasure. Thank you.
Thank you.